when you're making an investment decision, I think you need to always think backwards from your ultimate return on investment. And what many people don't realize when it comes to picking cities is that there are clear winners when it comes to your return on investment, and there are clear non-winners, those who do not perform as well when it comes to your return on investment when you think in terms of a buy and hold strategy over a full market cycle.
Order of operations when you're going to buy a rental property. Am I looking city first? Am I looking city last? Talk to me about that.
Yeah, most people get this completely flipped. Most people start property and pretty much end with property, and they just fill in the details when it comes to the team or the market. Most people don't know what their rent to price ratio is in their market. They don't know what their average home price appreciation is over the last 30 or 40 years. Mm-hmm. But if you don't know those things, then you're making a decision that ultimately may or may not put you in the best position to earn a better return on investment, right? So most people, to get back to your original question, most people think property, property, property. They fill in the details afterwards with market or team. Mm-hmm. If you want to be a successful investor, if you want to be in this game, enjoying it for a full market cycle, think 10 to 20 years or longer, like I have, and like our clients are here, you got to flip that. You got to start with the team first, because the team is what actually turns those fancy looking spreadsheets, those evaluations that we all make decisions off of, into real returns for you, real money in your bank account. It's the team. It's the property management team, which should be more than just a regular property manager. So start with the team first, then investigate the market. See the markets that that team is in, mm-hmm. and then go and choose between those markets. Lastly, if you do number one and number two well, you pick the team, and that helps you pick the right market, then picking the property is easy, fun, enjoyable, and you're going to pick a winner. At the end of the day, we need to invest without emotion here. So these properties that we are putting into our portfolio, think of them like stock. Think of them like bonds. You don't have emotion when it comes to that, right? You can do that for rental properties. They are the widgets of this asset class. And yeah, so that's what you do. Yeah.
And listen, Greg's, you've been doing this for like 17 years, mm-hmm. right? So like for you, this is so natural. For me, this is like a recently learned thing, right? Like I think I was like anybody else that I thought, if I need to invest in rental properties, it needs to be in my home market.
Right.
And I would, that's why we call ourselves the Not Your Average Investor Show, because that's the average way of thinking about it, right? Like I think most people in America think if I'm going to invest in a rental property, then I need to be within driving distance of it, mm-hmm. and I need to manage it myself, or I need to have Uncle Julio manage it, or whatever we're going to do, right? The first thing is to understand that if you get real good at realizing, hey, the world has changed, right? Like thanks to email and electronic stuff and all these different things, there is ways to remotely manage a property and to remote invest and be able to like have all the purview that you need, right, in your financial instruments, if you can find a team that can facilitate that, right?
Yeah.
Which is few and far between in a lot of markets. Obviously, Jacksonville has one. There's other places, other markets that you can look around. Mm-hmm. But once you have found the markets where there is a team that is suitable for you, mm-hmm. right? That has aligned priorities with what you want, mm-hmm. that has a transparency that you need, that has a scale that you need, that you can trust is going to be there for a long time, because you only buy the property once, but then you want to own it for 20, 30 years, mm-hmm. right? So like you're going to have a long-term relationship with these people. Mm-hmm. Once you find that boo to marry, mm-hmm. right?
I've called our properties like widgets before. I've never called the team the boo.
The boo. The property is the baby that you raise with your boo, right? Once you find markets with teams that suffice, right? That you can trust, and you can trust the experience so you can stay in a long time. Now you're looking at, okay, now I don't have to, I grew up in Miami. I thought I only had to do it in Miami. Now, once that changed for me, I was like, okay, where do you look? Different markets have different dynamics, which based on what your priorities are, mm-hmm. may or may not suit you, right? Like depending on if you are in a moment in life, depending if you're trying to maximize your ROI, you're looking one way, right? Mm-hmm. Like if you're trying to maximize cash flow, you're looking at different things, right? Sure. If you were a billionaire, you're looking in a different market than you are maybe like millionaire or 100,000aire, right? Maybe. And at the end of the day, it's really, really important, because when we do our client portfolios week over week, we see like one recurring trend, right, Juicy?
Yes, we do. What comes down, it's the Pac-Man theme that we see over and over and over again. So the reason why I said, listen, there are clear winners when it comes to certain markets, and there are clear non-winners comes down to an understanding of how your money is going to perform in real estate over a full market cycle. And what I find is that many people are focused on only one profit center in real estate, which is cash flow. That is what gets the most questions or the most attention in the beginning, especially for newer investors. But when you actually manage portfolios, I've had the blessing of managing over $800 million of real estate portfolios, and we report on their returns on investment every single month. This is a part of being a JWB client. And I look at their portfolios, some that have been owned for 2 years, some that have been owned for 4 years, 6 years, 8 years, 10 years, 15 years. And there's a constant theme. And that is when I look at their overall portfolio, 60 to 80% of their total returns on investment do not come from cash flow. 60 to 80% of their total return on investment comes from home price appreciation. So the reason why I say there are clear winners and clear non-winners when it comes to markets is because home price appreciation is cyclical in your market. If you know what your average appreciation rate is over the long haul, call it 30 years, 40 years, then each 10 to 20 year cycle, you're going to find that that average is likely to repeat. And so if you find the markets out there that have an average home price appreciation rate that is higher than the national average, you stand to benefit from that over the long haul. You'll probably get more home price appreciation. And again, home price appreciation is the biggest driver of your returns over the long haul.